why shorts haven't yet faced this giant margin call. Even though they've lost tons of money over the last few years, shorting not just AMC, but other stocks too, especially tech stocks in the first half this year. What's stopping them from being margin called? Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads, and also enter our giveaway. But everyone remember, this is not a financial advice video. According to an article that Carl Icahn has been losing a whopping $900 million a day. It says corporate radar Carl Icahn has lost $15 billion since the release of an expose by Hindenburg Research. That's over $900 million a day. Now, what's even crazier than the fact that Carl Icahn has lost this much money, or is continuing to lose this much money, is the fact that he hasn't yet been margin called. I think we have to remember that. Don't forget, these hedge funds aren't just working with a few $1,000,000 or even a few $100 million. Many of these hedge funds are working not just with billions of dollars, not even with tens of billions of dollars, but potentially hundreds of billions of dollars. And therefore, many of these hedge funds, like Citadel specifically, can be losing hundreds of millions of dollars each and every day, even $900 million a day, and still not be margin cooled. This is because they have such giant cash reserves that have indeed been dwindling over the last few years, and especially over the last 6 months in big tech stocks. But those cash reserves still remain, even though they're dwindled. Again, this article says that Icahn Enterprises stock has lagged for years, weighed down by huge losses. It says it's hard to argue about Icahn's lackluster performance as of late. This has been a lost decade for Icahn Enterprises stock. The stock price has fallen more than 60% over the past 10 years, while the S&P 500 has gained about 153%. Federal prosecutors are investigating Icahn Enterprises, but so far no charges have been filed. Now, you may question why Carl Icahn is being investigated by federal prosecutors, and it's because he's been accused of effectively running a Ponzi scheme. Maybe Carl Icahn has been lying about the true extent of his losses to other hedge funds and to other banks, and therefore hasn't yet been margin called. You may say, surely these hedge funds aren't allowed to lie to banks about the true extent of their losses, right? Surely that's never happened ever, right? Well, remember that arch egos use swaps to hide their true positions and likely hide the true extent of their losses as well. I do want to explain on the whiteboard exactly how that looks and exactly what happens as a result. But let's quickly recap on this article. It says Bill Wang, the founder of Archegos, was charged yesterday with racketeering and securities fraud. How Wang hid his positions teaches us a lot about how markets work today. Now again, we know how these total return swaps work. It's where these hedge funds can take positions or underlying positions in companies without holding the true shares or without holding the true short position. That way they can hide the extent of their true short position and not disclose that short position by effectively hiding it in different companies, different hedge funds, and different banks. It says a total return swap is pretty much like owning a stock. You get the gains if the stock goes up and you lose money if the stock goes down. But you technically don't own any of the shares. Instead, you've got a contract with a bank or with a different hedge fund to get the gains and pay the bank for any losses. And I think many of these hedge funds out there have been using these total return swaps to effectively hide the true extent of their losses. And this obviously isn't uncovered until the hedge fund ends up blowing up. So let's quickly explain exactly what's supposed to happen in a normal margin call situation, and then explain how Archegos was different. Let's say, for example, a hedge fund has its own personal equity and investor equity of around $2 billion. They take on $5 billion in loans from other banks, which is effectively their leverage ratio using what's that? A 2.5 to 1 leverage ratio. So with their own equity in the bank loan, they've got a total portfolio value of $7 billion. But obviously, if that total portfolio value falls to $5 billion or just below $5 billion, let's say $4.9 billion, they receive a margin call. Now the bank goes in and sells off that full $7 billion portfolio or sells off the now $4.9 billion portfolio so they can recoup most of their money back that they lend out. But let's say, however, that some of these hedge funds have been lying about their true losses and their true portfolio value. And some of these hedge funds actually have a portfolio value of only $1 billion. That means not only have they lost every single penny of their $2 billion in equity, but they've also lost most of the bank's money as well. Now, if or when the hedge fund ends up collapsing, the bank sells off that remaining $1 billion portfolio value and effectively takes a $4 billion loss. Now again, you might be saying, surely a bank isn't going to take a $4 billion loss. Surely they'd sell the positions way before then. Surely there's no registered event of a bank taking a giant loss when they wind down a hedge fund, right? Well, again, bank losses linked to the collapse of Archegos Capital Management now top $10 billion. Again, these total bank losses topped $10 billion after Nomura and UBS became the latest global banks to reveal the true impact of the hedge fund's failure on their finances. So again, when Archegos ended up collapsing and the true extent of their losses was revealed, a number of banks took on some heavy losses. It wasn't just one bank like UBS, it wasn't just two banks like UBS. And Nomura, there was tons of other banks like Credit Suisse that also lost money too. And that's why these banks took on some giant losses. Because these hedge funds, like Archegos, have been lying about the true extent of their losses. Actually, some of these hedge funds, like Archegos, should have been margin called a long time ago. But because they've been lying about their true losses and not making true disclosures, they've been able to hang on for even longer. And effectively, that's exactly what Carl Icahn is being accused of doing as well. Carl Icahn has been losing $900 million a day and is now being accused of running a Ponzi scheme and not accurately disclosing its losses. And again, this may have also happened with Credit Suisse themselves, as UBS are about to take on a heavy loss. As Peter Hahn tweeted, he said, "Look, something has got to be going on behind the scenes, and I continue to suspect it's some form of the January 2021 swap exposure still at play." He said, "We've had UBS noting it's on the hook for $17 billion in losses on absorbing Credit Suisse, and the Swiss government also provided a backstop of $6 billion. As Logan tweeted, he said, "How can UBS only spend $3.4 billion on Credit Suisse and have the Swiss government backstop the first $6 billion in losses, but still be on the hook for $17 billion of losses after that? The math doesn't work." So that's effectively a magical $26 billion worth of losses that UBS is now taking that they didn't first suspect when they paid out for Credit Suisse. AKA, maybe Credit Suisse also was lying about the true extent of their losses, and that's why UBS have had to absorb this additional $26 billion in losses. Now I can only guess what kind of toxic position they must have been holding to take on such a giant loss and not properly disclose it. And speaking of which, Crystal has tweeted saying the GameStop OBV is now at all-time highs. OBV is obviously something I've discussed at length on AMC, specifically over the last couple of years. But I've never really spoken about GameStop's OBV as well. But again, GameStop's OBV has been doing the exact same thing. Obviously, it rocketed up between January and March of 2021, but has still been climbing steadily since then. The OBV is the on-balance volume, which effectively works out the difference between purchased shares and sold shares. And again, the OBV on GameStop is showing that an additional 5.9 billion shares have been purchased compared to what has been sold over the last few years. Usually, when a stock price decreases, the OBV should fall alongside it as more shares are being sold, which causes the drop in price. But obviously in the case of GameStop and AMC, but actually no other stocks in the entire market, that's not the case because the OBV continues to rise as more shares are being purchased and not sold, and that's obviously because shares aren't being sold. In fact, the share price is being manipulated downwards instead. And again, we know that in AMC for a fact as there used to be 4 million retail. investors, and there's still 3.8 million of us years later. And that's because retail investors have not sold their shares, by the looks of things from GameStop's OBV. If anything, retail investors have purchased even more shares, which again likely means there's now even more hedge funds that are not disclosing the true extent of their losses, which are likely even larger than before. Now, Tony DeNaro tweeted saying this morning, I read through 900 plus pages of AMC Discovery posted publicly on the AMC Investor Relations website, covering board meetings from 2021 to 2023. And he said, I didn't see any discussion about helping shorts. Actually, quite the opposite. Again, this is something I touched on the other day when actually board members of AMC were talking about how APE would actually be damaging for the shorts and would likely cause them to close out of their short positions, or at least make shorting significantly more difficult for them. Again, it's good to see that Tony DeNaro is agreeing, especially after he's read through all 900 plus pages of data. Again, as I've been saying for some time, this is because Adam Aron is on the side of retail investors. It's just simply these hedge funds that are not disclosing the true extent of their losses. But when these hedge funds do end up collapsing, all it's going to do is make the situation even worse. Because when these hedge funds end up collapsing, it won't just be the hedge funds that take on losses, it will be some major banks that take on very heavy losses as well. All of the money that these banks have lent out to these hedge funds is likely going to disappear as well, which again is likely going to make the banking crisis even worse, where we may end up seeing some major banks collapsing too, which as a result is likely going to make the AMC and GameStop squeezes even larger. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.